The Feds bumped up the base rate another 75 points at the end of September. So, should you buy a house now or wait till 2023? Hey everyone, it's Alyson with Live South Denver, your real estate strategist and realtor for the South Denver area. So, with mortgage rates pushing into the sixes, they were 6.3 yesterday when I was chatting with my lender. This news from the Feds on the base rate really isn't expected to have that much change or impact on mortgage rates. It's kind of already baked in there among all of the underwriters and lenders. They've been expecting this to come, but that doesn't mean the rates for mortgages isn't going to go up and increase for those November and December meetings that are still on the calendar for the Feds, because they've said they're not done doing their work and trying to rein things in on inflation. Unemployment is still quite low, which all of us think, hey, that's really good. We're in the mid threes, but they see that as a sign that they haven't done the work that they need to do. I mean, they're talking about wanting to see unemployment in like the fives. And another thing is we're all still spending quite a bit on goods, and real estate is not factored into that. But things like rent, food costs, medical costs, those are still going up. Things aren't slowing down in that realm. The things that economists say are helping inflation are that gas prices have come down, which is great. Though how long that will stay that way, we're not sure, because as we all know, things are still at unrest with Ukraine and Russia. And the other helpful component is that wages have not caught up to inflation. So they see that as a good thing. Most of us say that's not so great. So all of that really is a helpful backdrop as we start this discussion about whether buying now or waiting till 2023, maybe beyond, is the right decision for you. So who is actually buying homes? Who's bought homes early in 2022? What has that buyer profile been like? Well, a lot of first-time home buyers, which to many people, that's a surprise. There's been so much discussion about being priced out of the market and what a crazy market it's been. Well, actually, for the first half of 2022, 45% of home buyers were first-time home buyers, and that's right back up there where we've been over the last 5 years. We had a little drop last year in 2021. That market was crazy too, but we're right back up where we like to see it. Lots of first-time home buyers in the market. 58% of borrowers did not put 20% down on their home, and that is actually great news. I want to give hurrahs and cheers for that, because so many times we hear from people that they have to have that 20% down before they can buy a house, or they've mistakenly heard, or their parents have ingrained it into them that they can't get a house until they have 20% down. And there is certainly wisdom in that. It is great to have 20% down if it's available to you, but it is not a must. It is not a rule. It is not a law. So it's great to see that so many buyers were able to get their house without having that full 20% down. And kudos to the ones who were able to skip that mortgage insurance because they had 20% down. And here are how folks secured their down payment. Obviously, many folks saved it. There are folks who sold a house to get it. I want to focus on those bottom two lines: retirement fund and selling stocks and investments. This can be such a useful way to come up with a down payment. I've had many clients do this over the course of the last few years. I've had folks coming out of California and they were on the entry level of a firm that has now been sold off and they have stock options. There's always some really cool stories that come with this. But the thing that I actually want to caution against is this. All of our markets are pretty volatile right now, it feels like, because none of us like the discomfort of watching values decrease or bounce or not be on a general upward trajectory. It's uncomfortable. So we're hearing more and more as I talk to my lenders and I talk to my colleagues and I hear from folks who are considering making a move that there is an idea of taking money, and lots of it, out of the stock market because of its volatility and putting all or most of it into a home or into real estate. And since I care very much about my clients and wealth building and legacy, I think this graphic is worth taking a look at and making sure we all understand the balance and the value of stocks in our portfolio as well as real estate. Just as it's hard to time the real estate market, we know it's hard to time the stock market. If you pull out your money while it's down, how are you going to know when to put it back in as it's on its way up? And will you have sold while it's lower and you're buying while it's higher? All of that is really hard to figure out. I am not a financial advisor. Talk to yours. I'm hoping you have one, but I really am hearing more and more stories of people wanting to take lots and lots of their portfolio out and put it into real estate. And generally, the stock market does yield better returns over time than having everything in a home. I don't want any of you to be house rich but functionally poor down the road. That pattern in the stock market, pretty obvious, right? Do you see the pattern here in this graphic? The red line is inflation, the blue line is the average 30-year mortgage interest rate. What this is showing us is that inflation is a leading indicator, the mortgage rate is a lagging indicator. This is what the lenders are counting on when you are talking with them and strategizing with them about how to get into a home. They are banking on exactly what you're seeing here on this graphic. Inflation peaks, and then mortgage rates peak, and then inflation drops, and then mortgage rates drop. And since right now we know that inflation is high and the feds are working on fighting it, mortgage rates are going up. And then as the inflation gets under control, which is the plan, we're gonna make the assumption that's going to happen as we look at these graphs and historical data, the mortgage rates are going to come down in like kind. It's going to happen after inflation starts to get under control. When you talk to lenders, when you hear their plan, their thinking, they're saying plan to refinance in the next 18 to 36 months. Some people refinance multiple times in that period because once you get a rate that's about 0.75% less than where you currently are, it starts to make sense. Now, if you don't want to refinance multiple times, people will wait. Just depends on how much benefit it is to you when the numbers start to show up in your favor. Refresher on the market. In April of this year, median home prices were up about 18% over 2021 and just short of being 40% over where they were in 2020. Those April median home prices were $617,000 for all homes, $680,000 for single family homes, and $437,000 for condos and townhomes. And the interest rate in April was at 5.25%. This month, we are at $575,000 across the board for all homes as a median sale price. We're at $640,000 for single family homes, and we went under $400,000 to $397,000 for the condos and townhomes. The rate today, 6%. Or a little higher. If we look back to the start of 2022, median home prices were $540,000 for all homes, $595,000 for single family homes, and $380,000 for condos and townhomes. And the rate, about 3%. If you saw this month's market update, which I just published last week, you'll know that for us to fall 2.5% to 4% off of our peak, just about 4 months after that is normal. Over the last 5 years, we've done that most years. We are more than that off of our peak right now at pushing close to 7%. And we're gonna continue to fall more than that as we push toward the end of the year and into early next year. So it is that mix of rate and seasonality. Let's talk terms. Appreciation. It's a term we all love. It's an increase in value. Depreciation, it's a decrease in value. Deceleration, that is where we are right now. It is when the home prices continue to appreciate but are doing so at a slower pace. So even at this month's market update, we were up year over year. We were still up 7%, 9%, 6%. Year over year, we were above where we were last year, but we were just slowing down the pace. When we're in these portals and we're in our home searches and we see price drop, price cut, new price, we're reading articles in the media about price drops and sellers dropping their prices. We hear drop and we think depreciation. Our minds make that link, but that's not how they quite go together. The price drop just means the home is taking a price cut. It's a little bit more on sale than where the seller thought it needed to be to sell. But let's say the house was listed at 1.2 million and that matched the comps from the month before and it ends up selling at 1 million. But a year ago, homes in that area all sold for $900,000. That home has sold for $100,000 more than homes sold in that area the year before, right? So there was no depreciation, but that home sure took a price cut, a $200,000 price cut. So when we're doing these market updates and we're analyzing the market, when the media is analyzing the market, we're doing appreciation and depreciation in year over year increments. When we're looking at price drops and acceleration and deceleration, we're looking at quarter over quarter and month over month. We know that we're going to be decelerating through the end of the year. The question is, will we re-accelerate when we get into the buying cycle next February? Or will we continue deceleration and even hit depreciation going into next year? Well, here's what the big Z, Zillow, says for their predictions for the home price index moving all the way into next year. We're going to look at South Denver area information specifically. So this covers zip codes throughout the whole country in every state, and I have highlighted the ones that cover South Denver area. And we are looking at data for today, right now in September, and where they say that we are, and it is accurate. Most of these are off from our high. And then it looks in the next column over. The next column over is looking at November this year, so just a couple months away. Again, downward trend in pricing. I absolutely agree. Seasonality, so of course. Then it looks all the way ahead to next year at the end of August, and nearly every single one of these zip codes shows positive trajectory for home price index. And again, I say yes, they're spot on. Is their number going to be correct? They're a year out. Even they don't really know. But for positive, I absolutely would say they are on target. And how about this? So far, we have had 129 months of positive home price appreciation since Q1 of 2012. So big picture, what do you think that means for what's ahead? Here are things I want you to consider as you're deciding buy now, buy in the next couple of months, wait till deeper into 2023. First, for every 1% change in the mortgage rate, your buying power is changed by 10%. On the plus side, if the interest rate comes down 1%, your buying power moves up by 10%. This is great news. And the reality of where we are today, because rates started at about 3% this year and we've moved to 6%, buyers' buying power has contracted by 30% this year. So, for example, if you're a buyer and you had $500,000 in buying power at the start of the year, but you didn't buy, maybe your employer didn't give you the approval to move out of state, so you stayed put. And here we are now, and you have the ability and the interest to buy a home, but rates are now at 6%. If your down payment hasn't changed, if your payment needs to stay the same, you've gone from $500,000 to $350,000 in buying power over the course of this year. How's that for bad news and a shock, right? Not what we want to hear. Let's look at it from another angle. Let's say you do have that $500,000. Now is the time to buy. You can handle these 6% mortgage rates. You've talked to a lender. We've got a strategy around how we're going to handle that. You realize you're not buying at the peak of the market. You know we're going to be pushing the seller for a rate buy down and addressing the interest rate component of it. And you're probably going to be refinancing in the near term. So buying now doesn't really scare you off. If you chose to wait, because friends, family, everyone around you is saying, don't do it, but rates go up to 7%, maybe higher, which we fully expect them to do, your $500,000 in buying power becomes $450,000 or maybe $400,000 very quickly. The question that's out there is, are prices going to come down in like kind and like power at the same speed to kind of counteract that? If you see a house you like at $500,000 and we've got the strategies and all the pieces in place to get it for you, if rates go up, do we really expect home prices to come down 10% to meet you and make it all even out? Right now, we just aren't seeing prices drop that drastically. So I'm not sure that that's gonna match up, right? So the home that you like at 500 is not necessarily gonna come down to 450. Now we can always still play the strategy game with rates, but it's a lot of money to buy down. So when we get to 7% and we're trying to buy down, we'll buy down to 6, not down to 5. So I just don't want people to run too far from the market when there is opportunity there. If you're renting, have you calculated the cost of your rent and what that might do for you paying your own mortgage instead? Say you're paying $2,000 a month in rent. In Denver, you're probably paying more, but that's $24,000 a year that you're paying into building someone else's wealth, to paying someone else's mortgage and not your own. If you have a down payment available to you, what else could you do with that $24,000 a year that was going to rent? Putting it into an appreciating asset and getting some tax benefits. All right, number 3, the type of home you're considering buying does matter in this market. I have a lot of people reaching out to me right now about new construction still. And for those of you who watch my channel, you know I love new construction because I have owned multiple new construction homes. I love building them. I specialize in them. Right now, I want you to be cautious about new construction homes. Now, a good spec build, a house that's due in 2 months or 3 months with loads of incentives coming at you from the builder, a specific close date, the ability to lock in your rate, I'm all for it. That is great. What I want you to really think about though is these builder homes that are listed on the internet because no one has bought them or someone backed out, that aren't due to be completed for another 9 months, maybe a year, and they're really at like full price. You might get some incentives, but you can't lock in the rate, or you're locking it in and paying quite a bit to lock it in a year out, and you're still in the standard builder's contract. We've talked about these. A standard builder contract is all builder friendly. They keep all your earnest money. They keep any money you put in after that, which means design center money. And this is something we haven't talked about much because it hasn't come up, but in the builder contract, there is a clause that says, if this home does not appraise when it comes toward the end, when they appraise it once the appliances are in and the curbs are in and the driveway is in, so right at the end, it doesn't matter, Mr. or Mrs. Buyer, you still have to buy the house. We don't negotiate with you. The only time that is not true is if you were on a VHA or FHA loan. So if you're on a conventional, a jumbo, you're on the hook. You have to come up with the difference. So I have clients right now who are due to finish a home in June of next year. The builder's delayed by several months. It was supposed to be finished earlier. They had less concerns about it. They contracted on this home in the peak of the market, bidding wars for lots, bidding wars for homes. And here they are going to finish when the feds are still promising to be raising interest rates and battling the market. And they're worried. They've called me and said, what happens if our house doesn't appraise at the very large number that we have purchased it at? The answer is, I don't know. I know what the contract says. I know the correct answer. And it is either you walk away and lose your earnest money, which is over 6 figures right now, or you pony up the extra, the differential, and you get to keep the house. Do I think that's actually going to happen? I'm not sure. Nationwide, if appraisals are falling short, do I think builders are going to renegotiate with their buyers? It would make sense. Have I seen builders be illogical and stand their ground and dig in their heels? Yes. So do I know that's what they'll do for the buyer? No, I don't know if they'll be logical. Do I know they'll renegotiate? No. So I've had to tell my folks, I'm not sure what will happen. So I want everyone to think very cautiously and carefully about new builds and what you're putting into them, how much you're offering, what your concerns are about rates, the contracts, all those things. Again, you know I love them. I want everyone to have a new construction home if that's what you want. I'm probably more of a fan of spec, short time frames, all of those things, because the builder contract is builder friendly. Okay, so on the other side, what if we're looking at existing homes? There are a lot more protections for the buyer in there, so I don't have the same concerns. The market does not scare me off. I don't worry about you going into looking at homes now in 3 months, in 6 months, because we can manage all the things that are coming at us. Sellers who are selling in this current market and the market to come have a reason to sell. Selling a home is taking longer and it's uncomfortable for most sellers. They don't like to have their home sitting on the market for longer periods of time. So we've really moved out of the season of selling a home just to see what it will fetch on the market for the most part. So sellers are motivated sellers. It's still important for buyers to understand that inventory is tight. They don't hold all the cards. We are not in a buyer's market. Beautiful homes. Actually, I just had a bidding war a couple weeks ago. So we still get bidding wars in this market. They are not all gone. There are still times where you have to tighten up the terms and give sellers what they want. This is not a buyer free-for-all in this market. So buying and selling right now is really a dance of finesse that requires as little ego as possible from both sides and a lot of trust with good representatives. The perks for you as a buyer, though, are you can close in a very short amount of time if that's what you want and the seller's able to get out of their home in a short time and they want that too. 2-3 weeks is entirely doable. Why? The lenders are not backed up. It's incredibly feasible for them to get your loan from start to finish completed in 14 to 21 days. Where in the peak of the market, when there were so many people pushing through their system, 30 days is what they needed to get it done. Again, we keep talking about this. You can land a rate buy down from the seller in most cases. So you're making your offer and you're saying, I want a seller concession from you of X amount. And then you're taking that and applying it to your loan and the lender is bringing your rate down from where we are today to something a little lower, a little more palatable, and it's taking a huge chunk off of your monthly payment because it's going straight to interest. It's not affecting your principal, which is manageable. It's affecting that interest wasted part of your payment. And in this market, you're not giving up rights and protections and contingencies. You're not saying, I'll have my inspection done in 24 hours and I won't ask you to fix anything, and forget it, I won't ask for an appraisal. And all of that has really gone out the door for the most part. So your protections as a buyer really still exist in this market, which is such a refreshing place to be in the market as a buyer. And then to compare new build versus existing home on another point, if you are somewhat cash strapped, the plus to an existing home is you're not going to be putting money into landscaping, window coverings, fencing, at least in most cases. The seller has already done all of that on an existing home where you have to put all of that cash out when you buy a new construction home. Let's touch on those rate buy downs in a little bit more detail. There are a couple different types of them, and it's important for you to understand. So there's a permanent rate buy down, which is where, like I mentioned before, you take that seller concession. Let's say you ask them for $5,000, $10,000, $20,000. I've heard of $30,000+ being asked from the seller to the buyer, and you ask the lender to apply that to your rate, and it takes your rate from, let's say today, 6.3-ish, and brings it down to maybe 5.25, 4.8, somewhere in that range. And it brings it down to something much more palatable than where it is today. And that is your rate moving forward for the next 30 years. It just stays with you. You just paid to have the whole thing brought down. That's a permanent rate buy down. Then the other kind is a temporary buy down, or you may have heard it called a 2-1 buy down. The temporary buy down has pluses and minuses to it. The pluses are it tends to cost a little less than the permanent buy down, and that money to pay for the temporary buy down goes into an escrow account. And if you don't use all of the funds for the temporary buy down, then it comes back to you. I know that sounds a little strange, right? But it's a 2-1 buy down. So you're buying down the rate a lot the first year, a little the second year, and then the third year it goes back up to where it's like supposed to be, like at 6.2 or 6.3. Well, if you were to refinance, say 14 months in, you didn't use all of the money. You didn't buy it down the whole time. So you get a little bit of that back. And so that's why it sits in an escrow account. And that's a plus, right? The downsides to it, well, it's temporary. So what if rates don't come back down drastically within 24 to 36 months and you're wishing they did? Or what if they go up? They most likely won't, but what if they did? And lenders are approving you based on the monthly payment at the end of the term, not in the front. So let's say your mortgage payment's going to be $4,000 after the buy down is over, but on the front end, it's like $2,800. Well, you don't get to go, I can totally afford $2,800 and I know I'm getting a raise before the buy down's over, so I can get qualified on the $2,800. No. The lender is qualifying you to be able to pay a $4,000 a month mortgage. They're not going to get on board with your plan for a raise between now and then. So you have to qualify for the $4,000. You have to be fully prepared to pay that $4,000 from day one and just enjoy the benefit of not paying it on the front end. Now, here's something amazing. I've got a lender who is stacking these buy downs like a perfectly cooked gooey s'more and making the most dreamy situation for buyers. That was a little mind-blowing to me, and I bet it may be a little surprising to you as well. There are so many ways to skin a cat. Oh, is that an okay phrase? There are a lot of ways to achieve a goal. Let's put it that way. Don't be afraid of this market. If you want to buy a home, we can make it happen. Housing inventory is going to remain tight in the coming months. The increases in inventory we are going to see are going to have as much to do with homes staying on the market longer as they are with the homes that come on to join the market as fresh inventory. Buyers are taking longer to enter the market and make decisions, so they play a part in this lengthening of inventory as well, because it's just taking longer for the homes to sell from the buy side. They're just not making quick decisions anymore. They can go see a home twice, see a home over 2 weeks, think about it. And so there's just not a lot of speed in the market anymore either. So what's going to win out? Are sellers going to have to do some drastic price cuts to get things moving? Will it make buyers the winners if they wait? Or will the fact that we're millions of homes short for the needs of buyers keep demand just tight enough that home prices soften up but things really keep moving forward on our traditional cycle and the market revs back up next year. Well, we are almost to 2023. Most people who start looking today probably will not buy until 2023. There'll be a few who jump in and finish up a home transaction before the end of the year. So this really isn't an argument for having to buy this year versus having to buy next year. If you're more comfortable waiting, there will be lenders to lend, money to buy with, homes to buy. There are also great reasons to buy today. Find the right home for you, find the right neighborhood. Don't be afraid of the market. There are ways to make it happen. Absolutely. You have certainly not bought at the peak, and there's never a way to figure out if you've purchased at the bottom. You have a lot of bargaining power in today's market if you are ready, willing, and able to buy a home and want to do so. If you want to chat more about this market and the strategies that we talked about, or have questions about some of the pluses and minuses I brought up, please reach out. I am always happy to connect. And I will see y'all next week.